An hourly worker at the arena paid a higher tax rate than the billionaire who owns it. Not by cheating, not by breaking a single law, by design. The 25 richest Americans got $400 billion richer in 5 years and paid a true tax rate of about 3%. You almost certainly paid more than that on far, far less. Stay with me, and I'll show you exactly how they do it, out in the open. And by the end, you'll see who pays the bill instead. Because someone always does, and it's closer to home than you'd like. Case number 5. Here's the trick, and it hides in plain sight. Your salary is income. The government taxes it before it reaches you. But a billionaire's fortune isn't a salary, it's stock. And stock that just sits there growing is not income, not until you sell it. So the move is simple: never sell. In 2021, a leak of IRS records showed how far this goes. The 25 richest Americans grew their wealth by $401 billion in 5 years. They paid a true tax rate of 3.4%. Jeff Bezos, wealth up $127 billion. True tax rate, 1.1%.
I was born into great wealth, not monetary wealth, but instead the wealth of a loving family.
In 2 years, 2007 and 2011, he paid 0 federal income tax. In 2011, he even claimed a $4,000 child tax credit. Warren Buffett, the man who says the rich should pay more, paid 0.1%, the lowest of them all. Now meet Adelaide Avila. She works the concession stands at the arena where the LA Clippers play and drives Uber on the side. $45,000 a year. Her effective tax rate? About 14%. The man who owns the Clippers, Steve Ballmer, worth tens of billions, paid about 12. The hourly worker paid a higher rate than the billionaire.
Right now, the average billionaire can wriggle their way to paying 8% as a tax rate, while the nurse or a firefighter making $45,000 is paying a 22% tax on their wages.
So if they never sell, how do they spend? How do you buy a yacht with stock you refuse to cash out? Tax lawyers gave the answer a name, 3 words: buy, borrow, die. Buy. You own assets, they grow, untaxed. Borrow. You don't sell. You take a loan against the stock, and a loan is not income. There is no tax on borrowed money. Elon Musk alone pledged around 92 million shares, about $57 billion, as collateral. Die. And here's the keystone. When you die, your heirs inherit the stock, and the gain it built up over a lifetime is erased for tax purposes. It's called step-up in basis. The capital gains tax on decades of growth is never paid by anyone, ever. This isn't a conspiracy theory. A U.S. senator described the exact same machine on the record.
A corporate raider buys a business. Then they borrow against its growing, untaxed value. When they die, the assets are passed to the kids, often entirely tax-free, and this cycle.
Buy, borrow, die is the engine, but the system has spare parts. Carried interest. Hedge fund and private equity managers take their pay and call it a capital gain instead of a salary. 20% instead of 37%. Congress's own scorekeeper says closing just that one loophole would raise $63 billion over 10 years. And the most recent study says the gap is widening. The effective rate on the top 400 fell from around 30% to 24%. The richer the country's richest got, the less they paid.
An extremely unfair tax code that allows billionaires to pay a lower effective tax rate than public school teachers, truck drivers, and nurses. And that has got to change.
Renaming income is just the start. The cleverest don't stop there. They reach for the one account built for the rest of us. The retirement account. The Roth IRA, built for the middle class to save a few $1,000s, tax-free. In 1999, a venture capitalist named Peter Thiel put a startup's founder shares into his Roth. 1.7 million shares at 1/10 of a penny each, about $1,700. That startup was PayPal. By the end of 2019, that retirement account was worth $5 billion. And because it's a Roth, when he's old enough, he can take all $5 billion out, tax-free, every cent. Then there's what happens when they die, for the rest of the family. Normally, passing a fortune to your kids can trigger the estate tax, so they use a trust, a GRAT. You put your stock in the trust. It pays you back what you put in. Everything it grows on top goes to your heirs. The gift tax on that growth, gone. More than half of America's 100 richest people use trusts like these. Through more than 30 of them, casino magnate Sheldon Adelson moved at least $7.9 billion to his family, and by one estimate, sidestepped about $2.8 billion in gift tax. The lawyer who invented the trick figures it has cost the Treasury over $100 billion. Sometimes the loophole comes wrapped as charity. In 2017, a new law created opportunity zones, a tax break to pull money into America's poorest neighborhoods. Invest there, hold for 10 years, and the tax on your gains can drop to zero. Here's how it actually went. More than 90% of the money flowed into big, already booming metro areas. Almost none of the housing it produced was affordable. Most of it rented above the local market rate. The records show zones drawn around land already owned by billionaires. A stadium project, a downtown high-rise, a strip a Treasury official personally stepped in to include. A break sold to help the poor, built so the rich could pay even less. And it isn't only people, it's the companies too. In 2018, Amazon reported $11 billion in US profit. Its federal income tax bill? Zero. It got a refund of $129 million. It wasn't alone. One study found 55 big, profitable corporations, names you'd know, paid nothing in federal income tax on a single year's profits.
Last year, 55 of the Fortune 500 companies earned $40 billion in profit and paid zero in federal taxes. It's not fair.
All of it legal. Write-offs, depreciation, credits. The same playbook, scaled to a balance sheet. You paid withholding from your very first paycheck. They booked billions and paid the government nothing. Every year, someone tries to close the gap. Senator Wyden's Billionaires income tax. Tax the gains as they grow, even unrealized. It would hit fewer than 1,000 people. Estimated revenue, over $500 billion. It has been introduced, and introduced again, and again. It has never become law. Why does it always stall? Because the people who would pay it fund the campaigns of the people who'd vote on it. The loophole isn't a bug someone forgot to fix. It's a feature someone paid to keep.
Their fair share. And I'll close with the gut punch. Everything I have described is legal. Everything. perfectly legal.
So, who pays the bill instead? Add it up, not the schemes, the cost. The Treasury estimates the richest 1% skip about $160 billion in taxes they owe every year. And erasing the gains people build over a lifetime, the step-up drains roughly $70 billion more a year. That one's not even cheating, it's the law. Money the government still needs, so it comes from somewhere else. Payroll tax, sales tax, you. The bill never disappears. It just moves down to the people who can't afford a lawyer to move it back. Remember the arena worker from the start? She paid her 14% on time. So did the billionaire in the owner's box, 12. That's the system working exactly as built. You followed the rules. You paid on time. So did they. That's the whole point. The system isn't broken, it's finished. It was built to do exactly this.